Today, Governor Lowe and the Reserve Board met, and yes, we have a rate movement. That's right, 25 basis points cut, bringing the cash rate down from 1.5% down to 1.25%. Now, for all you data nuts, I'm going to give you a little bit of a backstory in regards to where the cash rate has been. So, it is the first rate move of any rate movement since 2016. That was August 2016, our last rate move. Now, our last rate move up was way back in September of 2009. That's when the cash rate moved from 3% to 3.25%. Now, that was part of a tightening cycle that saw the rates move from that 3% right up to 4.75%. And that finished in November of 2010. And that's when we basically saw a flat period. And then from November 2011, we started to see our first rate cut in this particular cycle. So we've had rate cuts actually since November of 2011. And here we sit today with a cash rate of 1.25%. Now the question is that all? Is there more to come? Well, I'm going to answer that in a little bit later, but I want to talk about how do we get to this position? Because remember, we were supposed to be in emergency rate settings, but obviously we've seen globally around the world that lower interest rates are going to be here for a lot longer. And we're not seeing the sort of material impact that we would normally see when we move monetary policy. What are we talking about there? Well, normally as you bring the cost of money down, you get inflationary pressures, you get, business investment and those types of things. Well, we're not seeing that inflation flow through. So that is the big key reason why we're seeing the Reserve Governor move, in addition to obviously a slowing economy. So I've got my 3 reasons why we've been in this slower GDP environment. So I want to go through them. Firstly, the lever for this was back in 2015-16, we had a booming property market. And that was causing all manner of concern in terms of, because basically the whole infrastructure around the economy is underpinned by residential property and our wealth in the residential property space, but we were getting too heavy in debt, and so the macro-prudential interference by APRA started way back in actually December of 2014, and they continue to do more and more work there. So that slowed the property market up, and probably too far. And so now we've got an impact of consumption slowdown. That's the wealth effect that I've talked about many times before. So we're now through that, and we're basically going to see some incentives there, which I'll talk about in a minute. The other one, if we cast our back to the first half of 2018, I've talked about this also, we had an economy moving at around 4% annualised growth. And so we were talking about rate rises at that time, but we did see the federal Liberal Party implode after they sacked Malcolm Turnbull, and they also moved away from their NEG, which is the National Energy Guarantee Policy that they also put out there. So if you're listening, ScoMo, and everyone in the Liberal Party, bring back the NEG. I'm glad to see you back in power to be able to move the economy forward, but you've still got some work to do there. So now we don't have that. We basically have some certainty. And that was obviously the third concern. In any type of federal election, there is usually uncertainty about what's going to happen. And we definitely saw that in regards to Malcolm Turnbull gets knocked over, business confidence suffers, the cost of energy was going to be a problem for investment in business in this country. So we did see that play through. Add to that the Labor Party's agenda around large reform, higher taxation, and we did see business confidence start to wane. Now, we're going to see a bounce, and I'm going to talk about where that bounce is coming now that we have certainty around our federal parliament for the next 3 years. I also now want to talk about some of the language that's being used by the RBA in regards to how we got to this position around GDP and some other concerning things. So I'm going to read from their quarterly statement of monetary policy, because I think there's some extracts in here that give us a few clues as to why this has occurred. And I'm trying to keep this into layman's terms to make sure we can get an understanding of basically what's happening. But in that overview, they talk about gross domestic production. So growth in the Australian economy has slowed and inflation remains low. Subdued growth in housing income and the adjustment in the housing market has affected consumer spending and residential construction. And that is the big piece here. Okay, so they've led them as they've seen them, basically saying that, you know, this is the biggest problem we've got around consumption. Because remember, consumption is 60% of GDP. So it goes on, despite this, the labour market is performing reasonably well. We've got sort of unemployment around that 5%, and the underlying inflation, which is what they're trying to push up, has been lower than they expected at around 1.5% over the year to the March quarter, with pricing pressures subdued across the economy. GDP growth is expected to be around 2.75% over both the 2019 and 2020 period. Now, this is lower than they previously forecast. So both the RBA as well as Treasury are now saying that that growth is going to be a little bit lower, which is effectively saying reflecting the revised outlook for the household consumption spending and dwelling activity. Stronger growth in exports, so we're going to see that, in terms of iron ore prices, we can see those at around $108 to $110 a tonne. Now, what's caused that is obviously Australian iron ore is the best iron ore in the world, and there was a very bad incident over in Brazil where the other good iron ore, where they had a dam collapse, and so the production of iron ore in Brazil has been tapered, and so the Australian needs of that iron ore into China are really big, and that's what's pushing the prices high. And that's bringing in an incredible amount of revenue into the federal coffers at the moment. Now, that's also on the back of the fact that the Chinese government has introduced some stimulus in terms of infrastructure spending, which requires an enormous amount of steel and coking coal. So that's obviously why our ore and our coal are doing so well. And considering the estimates that we had in all of the budgetary things around what the price of iron ore will be, we're well and truly above that, and that's obviously meaning greater revenues coming into the federal coffers. So it's important to understand that that's why they're adjusting that. In terms of CPI, so that's the Consumer Price Index, which is the inflation measure, they're saying that could be below 2%, and they see that potentially adjusting in 2021-22. So we've got this low inflation rate, which is problematic. We need to get that up. We need to get jobs growth. We need to get pressure on that to get that income flowing through. So I'll finish off in terms of the GDP story. It says GDP growth was softer than expected over the second half of 2018 because of the uncertainty in our political environment, and that meant businesses weren't willing to spend after strong first half growth. Consumption growth has slowed noticeably, especially for those with discretionary items that tend to be correlated with housing conditions. So this is that extra spending that we were doing when we feel comfortable about our properties going up in value. Our properties were going down in value. We were uncertain about our jobs, and so we keep our hands in our pockets, and that affects obviously spending, which then affects employment and those types of things. So that's the big factor here in terms of that. So some temporary factors also weighed in on growth. We had the drought conditions, constrained rural production, supply disruptions affected resource exports, and the winding down of near completed liquid natural gas projects weighed on mining investment. Consumption and dwelling investments are expected to remain soft in coming quarters. Now that's an interesting sentence for me, saying consumption and dwelling investment are expected to remain. I think that with some of these rate cuts, and obviously we run a business that helps people buy property, we've definitely noticed an increase in inquiry. It is remarkably different to what we saw in April compared to what we're seeing post-election. And I've rung a few other industry people as well, and they're also seeing that noticeable increase. Now, you're not going to see that, and this is one of the important messages I also want to talk about today, is we're going to see GDP numbers for the March quarter be released tomorrow. Now, there's a lot of expectation that those GDP could show a negative or zero growth for the March quarter. Now, just be mindful, that is a lag indicator. Okay, so that's reporting on what's happened for the previous quarter. So we're going to see a bit of GDP numbers being a bit sluggish because we need to build that momentum back up again. So when you are looking and reading newspapers and seeing the reports in the media around the economy, just be asking yourself, is that a leading indicator or is it a lag indicator? Because it'll take a little while for the numbers to improve in the lag indicators, but some of the leading indicators are also going to be important, and I'll talk about those as I close out this presentation. So that's where we sit in regards to hopefully we'll see some rain in our rural areas and our rural production will increase, and then we see a modest pickup in mining investment is expected to support growth. So this is the bounce I want to talk about. So let's go through some of the subtopics here that we were talking about in regards to unemployment. Again, some commentary that we saw in the Statement of Monetary Policy. In contrast to the signals coming from the national accounts, a number of labour market indicators remain positive. So they're really happy about this. Employment growth is strong in the March quarter, following similar outcomes over much of 2018. The vacancy rate remains high, and there are ongoing reports of skill shortages in selected occupations. That's a good news story when we talk about wages growth in terms of income growth. So we need to get that. We also saw last week that the minimum wage is going to be increased from 1 July by 3%. So that means our lowest earners are going to get a 3% pay rise from the 1st of July. Now, if we also couple in the tax cuts, which means we're going to get a one-off payment for minimum and low and middle class incomes, we're going to see around $1,080 per worker. So if you've got two low and middle class workers, you're going to see potentially $2,160 being delivered into your bank accounts over the course of the coming months. Now, that's also if you think about what the Rudd government did with a $900 incentive during the GFC, that will flow through to retail spending and also stimulate a bit of that retail growth that we're looking for in regards to that. So they believe that the unemployment rate will remain around that 5%. But what was really important in Governor Lowe's speech last week that he delivered is that they want to push that story harder. They need to see a 4 in that number for unemployment, because what they're saying, based on innovation and the digital age and productivity improvements that we're getting through technology, we're not seeing those wages growing. So we need to push really hard into the 4s in terms of an unemployment rate to try and push wage demand and get those wages increasing, which is only good for prosperity and also good for the economy in terms of how that looks. Now I want to move into, so we were just talking about that in terms of household income. So this is what they said in their March statement. Weak growth in household income poses a key risk to the outlook for the household consumption, especially in the context of falling house prices and the need for many households to service high levels of debt. So if you think about it logically, if we have record level of household debt, it means that a lot of our discretionary money is being paid through in interest costs. Okay, so we don't want that. So if we can get some of that debt down, or we get a pay rise, then ultimately we can start to increase our discretionary spending, and that's good for economic growth and economic prosperity. So that's an important message there. The other important point there was in the context of falling house prices. So if we can see the bottom of the property market, then ultimately we might see a little bit more confidence in people starting to do their discretionary spending as well. So that's an important message. So that is where we sit in regards to what's been happening in terms of the economy. Now, I also want to note that obviously the rate cuts just happened now. I'm now talking to the bankers here who are listening. If you don't pass on the full 25 basis points, then you are lying to your customers. And I mean that very directly. Okay, there is absolutely no justification at all in terms of not passing on the full rate cut. And I'll use an extract again from the Statement of Monetary Policy where Governor Lowe is telling you, and I'm sure the politicians are telling you, and I'm telling you as well, that conditions have eased in domestic financial markets, with government bond yields falling to historical low levels. In fact, last week the 10-year bond rate fell below the cash rate in terms of 1.5%. The 10-year bond rate got below that, the government bond. That's never happened before. So that is signalling to you that there could be even further rate cuts coming, and we'll talk about that shortly. So it says here, so falling to historical low levels and equity prices have risen strongly. In addition, and this is for you bankers, pressure on short-term money markets has eased, reducing banks' funding costs. Banks bill spreads are now at their lowest level since 2017. Although this has not flowed through in most advertised mortgage rates, that's why we're talking to you. You have absolutely no reason to not pass on the full 25 basis points cut to all mortgage holders. So I'm putting it on your banks. The pressure's there. So there is no justification not to pass on that full rate cut. No excuses. Okay, so now let's talk about future rate cuts. And we saw again some evidence around what Governor Lowe said in his speech last week around inflation. If they are going to go after inflation, they need to go after that by basically doing a second rate cut, which most economists are thinking is coming in August. And there's even some commentary around a third rate cut, which will take the cash rate below 1%. There's even some people forecasting that the cash rate will get as low as 0.5 of 1%. Now, I'm not in their camp as much in regards to that, because I think what we are seeing out there is confidence in all the business leaders that I'm talking to has definitely turned. We now have, as we talked about before, some stability. We now have ScoMo in power, who's more centre right than far right. If he can organise our energy policy, I suspect there's going to be even further confidence in the economy, and that's a good thing. And that means that the RBA may not need to do as much of the heavy lifting in reducing the cash rate. Now, there's a couple of challenges here, right, in getting the balance right. The first thing is, do we want to see the property market start to go crazy again? And the answer to that is absolutely not. So we want to see a steady level of growth. We don't want to see a boom bust type arrangement when it comes to property prices. So the levers that both the RBA has and also APRA and the banks are going to have is going to play an important role in that. So if we do see further rate cuts throughout the course of the end of this year and maybe even into the new year where we do get to below 1% cash rate, we're going to see the banks and APRA be very careful about their settings around making sure that borrowers can't borrow too much money. Okay, now how will they do that? Considering that they've recently announced that they're going to reduce the 7% ceiling and introduce a 2.5% margin on top of what is the retail rate that consumers are paying. So they'll call that the assessment or serviceability rate. Now, so if rates are going lower, that means that assessment rate's going to come down, which means borrowers are going to be able to borrow more money. Now, how do we counteract that? Well, how lenders might look at that and explore that is a review of spending, household spending, and they may increase that a little bit in terms of the minimum spending expenses that they put in those applications, which means that's a good thing that we won't see a blowout in terms of what people can borrow. So we've just got to watch that closely, because the last thing the RBA and the economy needs is a booming property market, and even though that'll help with construction and consumption, we need to ease our way back into that. And if we think about the construction industry as a whole, we've lost a lot of those foreign buyers. So there's still going to be some challenges around medium and high density construction getting out of the ground, because they need to get those minimum pre-buys in regards to those pre-sales to get confidence to get the lending from the banks to actually build those particular properties. So we've covered a lot of ground in this presentation, and the reason for that is because obviously this is a big move and it's showing that there is potentially going to be a further easing as part of this cycle. So I think that's an important message for all. So I want to finish on just one important point, is how do we know that we're getting this consumption bounce? Okay, we talked before about, I said, don't panic about some of the economic results that you're going to see over the course of the next couple of months, because they are lagging indicators. The leading indicators that we really are interested in are these ones here. So I'm giving them to you. We do want to see, in terms of building approvals, we want to start to see that come back off its historical low. So We want to see some building approvals start to flow through, because it takes time for those approvals to actually then be approved for planned and construction. So we'd like to see an improvement in the second half of approvals, and then into the new year when we also see the introduction of the federal government's first home buyers deposit scheme. That's also going to have some stimulation in terms of allowing people with less deposits to get into the market. So we should also see some improvement. Now that was only for 10,000 households to be built, but we're potentially going to see that open up a little bit more if Josh Frydenberg is true to his word. If it's successful, they might introduce that. So construction, building approvals, number one. Number two, business confidence. We want to see a spike in the business confidence. And we saw a little bit of that in some data again from last week around the expectation on expenditure from businesses. So the numbers washed up at around a 6% increase in business investment and business expenditure in the 1920 and 2021 period. Now, I think that might even bounce a little bit more as there's a little bit more confidence moving in. I know in our business, we're looking to employ people, as opposed to, when the election came about, we were concerned about, what was going to happen to the property market and whether we could maintain the level of people that we had in our business. So I know we're a sample of one, but it just gives you an indication of the ripple effect that will occur across the country. Also consumer confidence. So we want to make sure that consumer confidence on the back of business confidence starts to also show up in the numbers over the course of the next couple of months. And then finally, retail spending. Once we know that's happening, we know that consumption and mindset and the wealth effect has passed where we're keeping our hands in our pockets and we're moving forward. They are the main ones. Now, the correlation of that is obviously the flow on is the unemployment rate starts to go down, because once we do get consumer confidence and retail spending, we employ more people. And as we do that, that unemployment rate will go down and we'll start to see GDP improve. So it has been a very, very long presentation. If you've hung around to the end, thank you for doing that. It is going to be an interesting time with further rate cuts anticipated through this year. Definitely one more, and the prospects of a third rate cut. Let's just wait and see in terms of how those indicators and those reports and indexes start to show up. But definitely an easing policy where we're going after inflation, and that's a good thing for economic growth and for economic prosperity. Thanks for watching.